end of the day, in my opinion, the only real way to reduce risk is to diversify. It's kind of markets 101, but it bears true today, especially in a market with so much uncertainty. I think all of us struggle with, should we be invested in primarily in shares, or should we be more in bonds or cash or property? The long and the short of it is you need some of all of the above. And through diversification, you can get that into your portfolio. And, in structuring a portfolio, I think more important than whether you have Anglos or Billiton in your portfolio is deciding, well, I'd like to have half my exposure in shares, I'd like to have 20% in property, I'd like to have 15% in cash, and get that right, and then have that structure, and that reduces the risk. Because at times your equity portion is going to be where you get the performance, and at unexpected times. I mean, who would have thought the last 3 years, everyone's been telling you should be in cash. The worst place you could have been is in cash, right? If one does a graph of what's happened to interest rates versus the markets for the last 3 years, at the same time, a lot of people have been saying going into cash, well, rates have come down from 10% to 5%, and the equity market's gone from 15,000 to 32,000. So who would have thought? Very few of us would have said equities would have doubled while cash rates would have halved. And that's why you need to have, if you want to reduce the risk, you need to have exposure to both. Because if you had only cash, you would be in trouble. But if you have only equities, well, you have a huge amount of volatility. I mean, 2008 wasn't a particularly pleasant time to be massively exposed to equities. For most of us, investors in our own right, having a 50% drawdown on your portfolio in 12 months is the last thing you feel like having. The risk of inflation is out there. I mean, you can't print as much money as we've seen central banks print without there having to be draining that off at some point. How long that's going to take, we don't know. I mean, interest rates have been at historic lows for a couple of years, and there's no real sign of them picking up. We've seen that the Fed has the ability to keep rates low for as long as people are willing to buy US paper, and there doesn't seem to be a lack of appetite for that at the moment. I think inflation risks are out there, but there are ways to combat inflation. So 10 years ago, inflation was a much bigger risk to us as investors. Why? Because it was pretty hard to get exposure to non-inflationary products like commodities, unless you were going and buying Krugerrands and stuffing them under your bed, which most people were doing at that time. The great news is you don't need to do that anymore. You can do that through things like gold debentures, which are listed on the exchange. You can buy commodity debentures over platinum, over silver. And the way I look at it is, at the end of the day, as part of your inflation hedge, you need exposure to commodities. So if you're worried about the scenario that we're talking about, then it's very easy to go and get some gold into the portfolio. But I wouldn't just have gold by itself, because gold comes with some disadvantages, right? I mean, there's a lot of hype built into the gold price. It doesn't have any real use. We pay an inordinate amount of money to pull it out the ground, to then go and pay people to put it back into the ground to protect it. Besides that, it doesn't have a huge amount of use. So I'm far more in favor of things like platinum or oil, which are functions of the global economy. And if there is inflation, the platinum and oil prices will increase. So as my inflation hedge, I would have, say, 20 or 30% of my portfolio in commodities. Remember, the downside to having commodities in your portfolio is they don't pay those nice things called dividends that stocks pay you, but they are very good in inflationary times. And of that basket, would I have all of it in gold? No. I might have a third to a half of it in gold, and then have a look at some of the other things. I mean, soft commodities, these are also a great inflation hedge, right? If we're going to see inflation, what's going to happen? The price of maize is going to go up. And you can buy ETNs linked to soft commodities as well. So you might, and this is the beautiful thing about it. For me, investing is like baking a cake. You have all these ingredients, and how you choose to add those ingredients depends on what cake comes out at the end of the day. And we'll all have a little bit more. Maybe I enjoy a little bit more chocolate, and you like a little bit more vanilla, and that's great. We have the ingredients, and we make the cake to suit what we like. So to your question, am I concerned about inflation? I am concerned, so I have some commodities. And do I have only gold? No, not only gold.